Today, more rate rises ahead, almost certainly. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, the RBA Minutes released yesterday really changed the tenor of people's thinking with regard to future interest rates. So you can look at, for example, the ASX 30-day projections, and you can see now that rates are expected to rise before sliding later. Very different story from just a day or two ago. So today I want to discuss what the RBA said and think through some of the implications. The point is, anybody who thought that rates were likely to be cut very soon are probably leading up a garden path, and by the way, that has significant impact with regard to expectations of future property prices. So members of the Reserve Bank of Australia's board believe that there's a strong case for further rate rises, with minutes from the April meeting revealing the central bank contemplated another increase amid concerns that population growth and public sector wage rises could fuel further inflation. While the RBA spared borrowers from its 11th consecutive interest rate rise this month, the minutes of the latest board meeting reaffirmed that further interest rate rises may be necessary to tame inflation. The release of the minutes prompted markets to increase the implied probability of a May rate rise to 35% from 24%. The RBA board considered raising rates to 3.85% amid concerns inflation may increase due to strong population growth and large public sector wage rises. RBA Governor Philip Lowe told the National Press Club earlier this month that we may well have to increase interest rates again, but we're not 100% certain of that. The decision to keep the cash rate on hold at 3.6% in April was, quote, to allow time to gather more information, the minutes said, citing jobs, inflation, and spending data as pivotal to the outlook for interest rates. Markets widely expected the RBA to keep rates on hold in April after the collapse of US-based Silicon Valley Bank and UBS's takeover of its rival Credit Suisse caused traders to dramatically reassess the probability of further tightening amid signs the financial sector was buckling under the pressure of higher borrowing costs. In fact, the minutes show the RBA board considered but opted against lifting interest rates by a quarter percentage point to that 3.85% level as it battles to bring inflation down from 7.8% to its 2% to 3% target band. This case was again founded on the observation that inflation remained too high and the labour market was very tight. The board noted that the RBA's latest set of forecasts were conditional on further tightening in monetary policy, and under those forecasts, inflation will only just scrape back into the top of its target range by the middle of 2025. Tolerating an even slower return to the inflation target by not lifting rates in April will be inconsistent with the board's mandate, the minutes read. Electricity prices are forecast to increase sharply in the September quarter, with default contract prices to jump somewhere between 20 and 30%, adding around a quarter percentage point to inflation in the financial year starting July 1. With Treasury forecasting an influx of 650,000 migrants between this financial year and financial year 2024, the central bank is also worried that high rates of population growth could put further upward pressure on inflation. Members noted that near-term projections for population growth could put significant pressure on Australia's existing capital stock, especially housing, which would in turn manifest in higher consumer prices. Although higher immigration might reduce wage pressures in industries that have been experiencing significant labour shortages, members noted that the net effect of a sudden surge in population growth could be somewhat inflationary for a period. While economists have been warning of further house price declines, the RBA board said there were signs the property market downturn could be, quote, smaller and more short-lived than expected, with prices now increasing in some capital cities and auction clearance rates bouncing back. Another argument in favour of the 0.25 percentage point increase was the increased risk of larger wage rises across the economy later this year, including in the public sector. Dr. Lowe had previously said that aggregate wages growth would need to remain under 4% to avoid stoking above target rates of inflation, based on historical rates of productivity growth. Overall, wages growth remained consistent with the inflation target, provided there was some pickup in productivity growth, the minute said, but the board ultimately decided to hold the cash rate at 3.6%, citing evidence that higher interest rates were already leading to a slowdown in housing spending growth, and the uncertainties around the effects of the fastest tightening cycle in a generation was having on the economy. Members agreed that it would be helpful to have additional data and an updated set of forecasts before again considering when and how much more monetary policy would need to be tightened to bring inflation back to target within a reasonable time frame. Now, Westpac's chief economist Bill Evans said the case for an interest rate increase was much stronger in May than it was in April. Since April's meeting, the board's checklist so far has supported a rate hike, he said. A stronger than expected jobs report last week showed a resilient labour market remained in the face of higher interest rates. The economy created 53,006 new jobs last month, the Australian Bureau of Statistics said on Thursday, and that outstripped forecasts for employment growth of around 20,000. The gains meant the jobless rate held at a near 5-year decade low of 3.5%. That's the fourth time in the past 6 months, while there are now almost 900,000 more people working than at the onset of the pandemic. And Mr. Evans said the April 26th March quarter inflation report would play a decisive role in determining whether the central bank will again opt to keep rates on hold in 2 weeks. For the RBA's February inflation forecast to eventuate, underlying annual inflation will need to fall to about 6.5% from 6.9% in the January to March Consumer Price Index data. A number significantly above that forecast would presumably put some doubt on the staff's 2-year path back to target, and certainly see a response from the board at the May meeting, Mr. Evans said. And the rebound in property and retail stocks on hopes the Reserve Bank of Australia has concluded its tightening cycle was premature, given the central bank may need to raise rates twice more this year to cool inflation, warned Morgan Stanley. Shares in property-related companies have been buoyed by early signs of a recovery in Sydney house prices and improved auction clearance rates, and the RBA's decision to leave interest rates on hold this month further bolstered the sector. Since the start of March, REA Group has climbed 16% and Domain advanced 9% in anticipation of a pause in interest rates after 10 consecutive increases in Australia. CSR, Stockland and Mervick Group also joined in on the rally this month. But Morgan Stanley believes investors have jumped the gun by assuming the housing downturn is over. We detect a bias in positioning to consider the interest rate pause as a precursor to ultimate easing of conditions and the start of the next housing cycle, hence the bouncing cash rate sensitive sectors, said Chris Nichol, Morgan Stanley's head of Australian strategy and economics. To us, this looks somewhat premature. Our conclusion is that buying into housing and consumer-facing stocks has poor risk-reward at this juncture. Morgan Stanley believes those sectors remain vulnerable, given there is a real possibility that the RBA will resume its policy tightening on the back of robust economic data. The broker highlighted last week's stronger than expected jobs report, showing the 53,006 people found work in March, and that beat forecasts for modest employment growth of 20,000. The gain meant the jobless rate held steady at a near 5-decade low of 3.5%. And Morgan Stanley expects the RBA will deliver 2 further 0.25% percentage point rate increases in August and September, bringing the cash rate to 4.1%. While Sydney house prices jumped 1.4% in March, the sharpest increase since October 21, the broker warned that house price strength was typically only sustained when the RBA started to cut rates. When looking at prior housing cycles, the bulk of price declines occurred when the RBA is on hold, Mr. Nichols said, And given our expectations of a prolonged period before policy actually eases, a return to price weakness cannot be ruled out. And Morgan Stanley also warned that retail stocks had found support before the worst of a downturn in sales had even started. The broker pointed to signals from the February reporting season that indicated that consumers were adjusting to tighter financial conditions, including deteriorating sales in big-ticket retail categories such as furniture. In comparable markets such as the UK, that consumer adjustment had broadened to electronics and home improvements categories. Australian companies could flag a similar trend in future updates, Morgan Stanley warned. And they said the consumer adjustment has really only just started. And with fixed interest rate resets, a likely contractory fiscal pulse in this year's budget, and the potential for the RBA to restart hiking in the third quarter, expecting a sustained consumption rebound would seem more hopeful than logical. Well, I'm not sure I could put it much better myself. Of course, there are many forces trying to talk prices higher, trying to get people to go buy. But of course, they have a vested interest. And the lenders, of course, also want to increase their mortgage book. But I think Morgan Stanley is on the money. I think the RBA will have to lift rates higher. I think that we will see further falls in house prices over the next few months. And as I said to Edwin on a Monday evening rant yesterday, I think by the spring, later in the year, we'll get a much better read as to the real trajectory of house prices. Certainly, the data so far is far from convincing. And once again, of course, spruikers love trying to talk the market up. But anybody with an ounce of reality in their head should, I think, listen to Morgan Stanley and be much, much more cautious. As the RBA said, rates will almost certainly have to go higher. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.